The stock market will plunge 33% if the government defaults. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of Heise Says US. Grab your mug or stein of coffee. Let's have a look at this article from Yahoo Finance which is warning about a potential stock market plunge. So the stock market will plunge 33% if the government defaults, according to Moody's. So let's jump here and have a look at the market. No, we're not going to bring that up. We're going to look at the market today. And we can see, let's go out to, 12 months time. As I look over here to see it, well, there you go. This is the S&P 500. It's just been going up. Let's go to 5 years. Here you have it. And let's go to max. Yeah. It's doing pretty well. If Trump was still in power, he'd be claiming a lot of credit for that. What do you reckon? So let's have a look to see if this is something we should be concerned about. So President Joe Biden very often cites research from Moody's when he's trying to make a point on the US economy. He should use the latest from Moody's Mark Zandi to emphasize any points being made to fellow politicians on both sides of the aisle on the need to get a debt ceiling deal done as soon as possible. Shutting the government down would not be an immediate hit to the economy, but a default would be a catastrophic blow to the nascent economic recovery from the COVID-19 pandemic, said Zandi, the widely followed chief economist at Moody's, who rose to fame for prescient calls before and during the Great Recession in a new piece of research. The blow from a default on our debt due to lawmakers not extending the debt ceiling would be particularly acute to investors in the stock market, according to Zandi. Stock prices would be cut almost in 1/3 at the worst of the sell-off, wiping out $15 trillion in household wealth. Treasury yields, mortgage rates, and other consumer and corporate borrowing rates spike, at least until the debt limit is resolved and Treasury payments resume. Until then, rates never fall back. Even then, rates never fall back to where they were previously, since U.S. Treasury securities no longer would be risk-free. Future generations of Americans will pay a steep economic price, said Zandi, referring to the potential fallout in asset markets. In large part, the stock market pressure would reflect the major economic blow dealt with debt default, explained Zandi. The hit to consumer, business, and investor confidence would be severe if the impasse over the debt limit lasts through all of November. The Treasury will have no choice but to eliminate a cash deficit of approximately $200 billion by slashing government spending. Annualized, this is equal to more than 10% of GDP. The economic blow would be devastating. Zandi's dire predictions come on the heel of Treasury Secretary Janet Yellen warning of a catastrophe if the debt ceiling debate isn't settled. The US has never defaulted, not once. Doing so would likely precipitate a historic financial crisis that would compound the damage of the continuing public health emergency. Default could trigger a spike in interest rates, a steep drop in stock prices, and other financial turmoil. Our current economic recovery would reverse into recession, and billions of dollars of growth and millions of jobs lost, Yellen said in an op-ed in the Wall Street Journal. As it stands, lawmakers remained locked in a contentious battle on the issue. On Tuesday, the Democratic-led House passed a short-term government funding bill that maintains funding through December 3rd. It also includes a provision to suspend the debt limit through to December 16, but the bill is likely to die on the floor of the Republican-controlled Senate. So there we go, everyone. What's the takeaway in this solution to this? Well, let's have a talk. Is this something we should really be worried about? Is a lot of fear and posturing? We saw a similar thing here in Australia with regards to predictions of catastrophic house price corrections. The Reserve Bank was predicting a 40% fall, or modelling a 40% fall. They weren't predicting it, they were testing the impacts of it on the economy. Every of the major four banks, which banks here in Australia make up a significant portion of the top 10 businesses on our stock exchange. Housing is a huge part of our economy here in Australia. So we had all of this fear coming out in the media at the beginning of the pandemic. And what's happened? Well, we've had very little housing correction, and now they're predicting housing to go up by 20% at the end of this year. So it could be that this is all done for political purposes, to get fear, manipulate, and push the Republicans to, well, allow a debt ceiling to be removed. Can you imagine? What would the Democrats do if that happens? You tell me. As always, thank you for watching. Like, share, and subscribe to the channel. If you're a fan and enjoy the content I cobble together here, there's a few ways you can support us. You can join us on YouTube or Patreon. Sign up for Self-Wealth or Stake. Use our affiliate links at Amazon, eBay, Independent Reserve, or Aussie Broadband. You can buy our merch from Heise Says, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day, and keep an eye on the markets. Bye for now.